So, trader, what is liquidity and how does it actually behave in the market? To answer that, we need to approach it from a practical perspective, focusing on how smart money interacts with liquidity in real trading conditions. Before moving into patterns and execution, it is important to understand what these concepts mean on the chart and how they influence price behavior. Now, consider how large financial institutions, often referred to as smart money, operate when they want to build a position in a currency pair. To execute that position, they need sufficient liquidity, meaning a large number of participants willing to take the opposite side. Without available sellers, buy orders cannot be filled. This is why the market often moves in a way that triggers existing stop-loss orders, providing the liquidity needed for these larger players to enter or exit positions. From a retail perspective, this can feel like manipulation as price creates moves that appear clear, only to reverse after taking liquidity. This creates a common trap. Many traders believe they are positioned correctly, but the market moves into their stop losses first, takes that liquidity, and only then continues in the expected direction. For a trader aiming for consistency, identifying liquidity on the chart is not optional, it is essential. These zones, where orders are concentrated, reveal how the market is likely to behave and help you avoid unnecessary losses. Liquidity can be classified into two types: static liquidity and dynamic liquidity. Let us break both down in a practical way. Dynamic liquidity relates to the forces that drive price movement. In simple terms, it reflects how price flows through structure. To visualize this, think of a typical market swing with a defined high and a low. These highs and lows represent external liquidity. External liquidity refers to the liquidity resting beyond key swing points. On the other hand, the fair value gaps within that range represent internal liquidity. Price is constantly moving between these two types. In practice, the market cycles between internal and external liquidity, moving from one to the other in a continuous flow. Looking at this schematic figure, we can see a rally wave moving upward, sweeping the external liquidity above the previous high. After that, price shifts toward internal liquidity, represented by a fair value gap, to rebalance inefficiencies left behind. From there, price transitions again toward external liquidity. In essence, the market moves from internal to external liquidity, then back again. Once external liquidity is taken, price often seeks balance by returning to internal liquidity, filling the most recent gaps. Now, shifting focus, let us examine static liquidity. Static liquidity refers to specific areas on the chart where a large pool of orders is resting, such as stop losses and pending buy or sell orders. Every time a stop loss is triggered, that liquidity is absorbed by the market. This is why recognizing a liquidity sweep before price reaches a key level is so important. It provides confirmation that your area of interest, whether supply or demand, has a higher probability of holding. Liquidity sweeps are not random. They are part of how the market builds momentum. If price does not take liquidity before reaching a level, it will often use that level itself as liquidity. This is why understanding where liquidity is located is critical for timing and execution. Static liquidity can be identified in several recurring areas on the chart, such as below equal lows and above equal highs, above swing highs and below swing lows, around trend lines and channels, and within or around order blocks. It is also present around support and resistance levels, Fibonacci retracement zones, and near the body and wicks of daily candles. When you consistently recognize these zones, you begin to understand how strongly they influence price direction. Ignoring them often leads to unnecessary losses. Some of these areas attract more attention than others, especially those widely recognized by traders, which leads to a concentration of stop losses and pending orders, increasing the probability that price will move toward them to capture liquidity. So trader, please remember that the ComLucro channel is focused on giving traders clarity, confidence, and structure. And this Smart Money Concept series is designed to do exactly that. Each video breaks down one ICT concept in a clear and practical way, helping you understand how price behaves, where liquidity forms, and how market structure develops. If this explanation helped you see the market with more clarity, make sure to check the full Smart Money Concepts playlist linked on the card and in the description, where all these ideas are organized step by step into a complete learning path.